Hello, everyone. My name is Jose Perez. I work with Coldwell Banker, and I'm here with my friend Jeff Montes, who actually works in a company called Foresters. It's an insurance company, and he has some important things that I believe will benefit each client that I've been working with, or any purchaser or homeowner. And it's interesting the things that he's got to share with us, and I would really want you guys to listen for a few minutes of what he's about to say. Jeff, tell me a little bit about the company, the mortgage protection plan that you
Yeah,
guys carry.
sure. Thank you, Jose. Yes, we've been around for about 140 years as a company, and Foresters is one of the leading in the industry. We actually underwrite products for three countries: Canada, United States, and United Kingdom. And we have a special product that is designed for homeowners. It's a mortgage protection product, which basically it can do multiple things. Among those things is to, God forbid, something does happen to you, your mortgage is actually paid, and your family doesn't have to worry about, trying to keep their home. On the other hand, as we're going to see in a few minutes, there's other benefits that are add on to that. For instance, if someone loses their job, and in 15 years into their home ownership, they, life is like that, and now they can't really make their mortgage payments, concerned about losing their home. I'm going to show you that there's some cash value that accumulates in this particular product that can be utilized to either pay your mortgage off, depends on the years, or utilize that money to keep making your payments. So as we go on, I'm going to show you the essence and the key of what we're talking about.
Okay, great. Well, basically, I'm going to try to cover a couple of questions here and there, and
Okay.
maybe it'll. I'm going to try to see if we can make this a short video, just so that we can hopefully make a second one where folks can really uh, get some benefit out of this. All right. So
Sure.
tell me a few scenarios, or apart from the scenarios, uh, tell me a little bit more about why is it important. Tell me why would someone, a homeowner, why would someone want to buy something like this? What's the benefit? And then maybe you can run a couple of scenarios as to see, for example, if I sell the home and a buyer wants to learn a little bit more about this program, how does it benefit him or her, and why should the homeowner buy it? Because
Sure.
I guess that's what they really want to know about.
Sure,
Reason
sure.
why.
Yeah, these are products that, like I said, have been around for hundreds of years. Unfortunately, uh, if we're not, if we don't know that they are around to protect ourselves, um, uh, obviously we won't be able to avail ourselves from them. But let me just make sure we make this clear before we go on. This has nothing to do with PMI. This is something that the homeowner gets personally for themselves and their family. Is not designed to protect the banks. It's not designed to protect the lender. It is strictly designed to protect the homeowner, the individual, the person. So the importance of protecting their mortgage is quite frankly, a house is one of the biggest assets people will buy in their lifetime. And oftentimes, as we know, we buy a home, our mortgage term is for 30 years, and we get into it, but somewhere along the way, life could bring things that are unexpected. So if that extra cash is always um, a beautiful thing, and not only that, but also, you see, sometimes if, God forbid, something does happen to the person that's paying the mortgage. Let's just say that person loses their life. Let's say that person now becomes disabled and can no longer afford the payments. That's when the real stress begins. So I want to show you what happens to a homeowner that avails themselves of this, attaches it to their mortgage payment. and let the numbers speak for themselves.
Great. Why don't you go ahead and maybe show me a couple of scenarios, because for what our last conversation we had last time,
Yeah,
it seemed that I mean, it really made sense to me, and and this is what I actually wanted to share to not only my clients but every homeowner that is out there that has a hold of this video, because I think this really made sense at the beginning. It didn't make sense, but then in the long term, looking at
sure,
the amortization table
sure.
and the investment of the long term, the
Yes,
security overall, it just made a lot of sense to me as far as the protection that it provides to the homeowner
sure,
if they're planning to keep their home or making a mortgage payment for over 20 years. So
sure.
yeah, why don't you? I gave you earlier before we came in live. I gave you three specific ages that I
Sure.
had just recently dealt with. So maybe why don't you show us what what's that all about? And
Sure. Yeah. Let's begin by let me use here this little tool that you recommend here to get an idea of what we're going to be looking at. Uh, let's look at a mortgage amount for 120. Oops, for 120 $1,000. This is what the payments are going to look like. Just bear with me here. Are you able to see the screen?
yep, yep, I can see it.
Okay, wonderful. Let me just see here. This is what the loan or the mortgage for 120,000. It's going to look like over time. Now, I just want to bring this down to, let's just take it 20 years from now. You know, usually the loans are 30 years. So let's just take it 20 years from now. See what happens and how that's looking for us. Let's go down. Please excuse my mouse here. It's still sleepy, running a little slow here. There you go. Okay, so we'll fast forward at 2035. So this particular scenario,
Okay,
I'm just going to highlight really quick here.
okay,
Actually, we're in March, so let's go to March.
okay,
We're fast forward 20 years from now. According to this, the balance in this particular home is going to be $58,000 up to
This
that
is
point.
this is based on $120,000 purchase, right?
That's
Mortgage.
correct.
Okay,
That's a $120,000 purchase. Okay. In March 2035, which is 20 years from now, this particular homeowner will have a balance of $58,000 in their home.
okay.
Right? We
In other
still
words,
have another.
that will be the debt that they will still owe by after 20 years.
That is correct. We still have
Okay.
another 10 years to go.
Yeah.
But I just want to give you a few scenarios so we can look at this. So
Yep.
let's say March 2035. This particular individual, you know, he's done his payments and he owes to the bank $58,000. Now, let me bring you to our mortgage protection tab here.
Okay.
And we had said this particular homeowner was 40 years old at the time of purchase. So we're going to use the $120,000 for his mortgage. Now, what you're seeing in here, it's a beautiful thing, and I'm going to explain that to you as we move along. You see this little tab where it says accidental death,
Yep.
and this little circle where it says chronic, critical, and terminal illness?
Yep.
Okay, I'm going to explain to you what that means on the next screen. These are two features that are actually built into the product, which basically means this, Jose. Let me start by saying this. The initial face amount, what we call, is $120,000, which is the amount of the loan. What that
Right.
means is, in the previous screen, what that means is, God forbid this particular homeowner has an accident and passes away in an accident. See, there's a combination of life insurance benefit in the product, because what that means is that this $120,000 will be automatically converted into 240. Okay, and the beneficiary for the homeowner will get $240,000. Now, the second tab that you saw, which is said critical illness, that means that if this particular homeowner, is ever diagnosed with any type of critical illness, the word says it, it's a chronic illness, or God forbid, yeah, we don't think ahead, but let's just say he's in his 60s and he goes into a nursing home because there's something wrong with him. Well, then what happens is 75% of this 120, the homeowner can take out up front. And what that does is it can be utilized for multiple things. It can be utilized to pay off the house. It can be utilized to put their financial life in order. See, we must never forget that these products are designed for one thing, and that is to stabilize the finances of a household. Okay, that being said, let me take you back down to our little table here. Basically, what it means, what you're looking at here, Jose, is the age of the person, okay, the years of the mortgage protection product. That's the payment that he will have annually, which it will break down to $183.38 per month. That's a total of $2201. As the years begin to pass, their payment begins to accumulate. And I also want to show you this last tab here that you see that it says death benefit.
Okay.
God forbid the homeowner passes away. He will be given this money to pay off his mortgage. Okay, now, obviously that's a conversation some of us don't like to speak about. We're not thinking about dying. We just want to protect our assets, protect our families. So let's go ahead and let's move this up and fast forward 20 years from now. Now, look what begins to happen as time progresses. This particular homeowner, and I'm highlighting this so you can see it clearly. This particular homeowner is now 60 years old. He's been 20 years into paying his mortgage. This is the amount of money that he has actually put in to protect his household. Okay?
Okay.
In 20 years, he had put in $44,011, correct?
In other words, the 2,201 payment per year, you multiply it times 20 years equals $44,011, basically.
That is correct. That's what
Okay.
it actually
So in other words,
yeah.
as long as they paid, what was that amount? $108?
$183.38.
Right, per month, then the total amount will be $2,201 a year to be able to cover themselves for the future. So now,
Sure.
at the age of 20 years now, fast forwarding 20 years,
Yes.
44,000 will be the total amount that he had already paid at that
Correct.
time. Okay.
Correct.
Continue.
So absolutely correct. So what now begins to happen is he's put in $44,000, but he has accumulated between the amount he's putting in and some interest, $53,000. Now this is cash. Okay, this can be accessed at any time. The number you see here, the 173, what has happened is the original amount, which it was to protect the loan for $120,000, is now being, this 53,000 is now being added on to that. So let's just say, God forbid, the homeowner passes away. There's a death benefit attached to it, which it will give the beneficiary $173,000 obviously to protect their mortgage. Now, if you remember, at that particular time, let me bring it to the other top. The mortgage debt would only be $58,000.
Yep. Yep.
Okay, so if God forbid the homeowner passes away, there will be basically about $120,000 in cash extra. Now think about it. You have your house paid, and you have now, $120,000 in cash that could be utilized for the betterment of our families. Now let's just say, take the death element out of it, and let's just say we're just looking at regular life. This particular homeowner, is in his 60s. Um, let's say he loses his job, and he begins to worry and says, well, I lost my job. I still own a home. I still have a mortgage to pay. I don't know how to do it. I'm going to lose my house. Well, no,
Okay.
he's not, because he comes into this particular mortgage protection product, and don't forget, he has $53,000 that he has accumulated over time. So he could take that money out, okay?
So
And
wait. So wait a minute. Let me ask you this.
yes,
So what you're saying basically is that he can take the whole $53,000 out of the accumulation that he made, because he paid 44,000, right, throughout 20 years, but he
mhm,
accumulated 53, so there's an increment of about $13,000. So in
sure.
other words, basically what you're saying is that the homeowner, if he loses his job, he can take out those $53,000 and pay off the mortgage amount that he
That
owes.
is, yes, put it to you this way, Jose. This is up to the homeowner,
Yeah.
because, like I said, this is designed for the individual. We
Okay.
don't we don't deal with the banks. We don't deal with the mortgage companies. We don't deal with anyone else but the homeowner. So
Okay.
basically, the homeowner will say, uh, I have $53,000 accumulated. I need access to that money. It will be given to him as he chooses. Could be given all together as a lump sum.
Yeah.
And now what happens is he has $53,000 in cash. Now, does he choose to pay his whole house in one sum? Because as we see here at that particular time, the he would only his debt will be 58,000, so he could almost pay his whole house off
Right.
immediately, or if he chooses to say, you know what, no, I will just continue to do my mortgage payments, and there's $53,000 that could probably carry him for the next 10 years without having to worry about that. So there's multiple things that a homeowner can do. Now, here's the beauty of this. Let's just say life goes on as normal. Look
Right.
what happens to this homeowner at the end of his mortgage. 30 years.
Okay.
All right. Now follow me here with the mouse. He's now 78 years old. He's been 30 years. He paid off his house. Okay. He has no more debt, no more mortgage payments to make. He has put into his mortgage protection $66,000.
Right.
Okay. But he has now accumulated over $100,000.
Wow.
Okay, that's called equity. I mean, that's why this product is so beautiful, because now watch this. He just goes along about his business. He buys his house. He puts this together. He just pays the mortgage and pays his mortgage protection, and he just keeps doing it. By the time he's done, see, I showed you before. If in 20 years he decides to take that $53,000 out,
Yeah.
he will have shortened his mortgage 10 years right off the bat. Okay, but let's just say his life is stable and he just wants to go all the way. Okay, so by the time his mortgage is done, 30 years, look what happens. He accumulates, okay, over $100,000 in cash, and he's only put in 66,000. Okay, so now at that moment, not only can he have access to that money to retire, or maybe to buy another house, or maybe to send his grandkids to college, But if he chooses to leave it the way it is, and look, God forbid something does happen to him, and he does pass away, his family or his beneficiary will receive $224,000. So now, the intent to protect his house, he went the long distance, and he now has left his family a home that's paid off and $224,000 in cash. So it really doesn't matter which angle you look at this. Altogether, overall, it's a great product to protect multiple venues and assets of your life.
Wow, that's incredible. I have to say, I mean, this is the first time I'm hearing about this. To be honest with you, I didn't hear it. I've been in this business for since 2003, and I gotta tell you, it's the first time that someone actually approaches me with this information. I think, to me, it really makes sense, to be honest with you, because of the fact that, I mean, you're securing your home,
Sure.
and at the same time, if for any reason, and thank God that, I mean, you go all the way, for any reason, the death benefit doesn't, you don't get to utilize that death benefit, but at the time that you end up finish paying the mortgage payment and your home is free and clear from a mortgage, you're not only recovering your investment,
Sure.
but you're actually making
Sure.
somewhere about 40%.
Sure. Sure.
on top of the amount of the investment that you actually
Sure.
made.
Sure.
That, to me, it is just amazing.
Sure.
It's
Sure.
just
Yeah,
incredible.
it's equity, and it's equity, and it's basically what it does is what we've discussed. There is no way that, see, you gotta understand, Jose, and I'm gonna say this to you as friends. We have fallen short of realizing that these companies have been around for centuries. These products have been around for centuries. And, us as Latinos, this is an incredible thing. I mean, just the insurance in general is really the only way we can protect our assets and we can protect our income. Because think about it, Jose. You just said it. It's 40% more than what you have put in. Now that alone is what I would call the American way.
Yeah,
You know?
that's I mean, yeah, that's true. I mean, that the reality is that, I mean, if I put my money on the bank, I mean, my bank, if I leave it there, I mean, 40%, getting a 40% return is not a bad deal. And
No.
getting an insurance on a house, it's not really a bad thing.
Yeah, yeah.
I'm looking into this and I'm saying, wow, this is
Yeah,
something
yeah,
that
because absolutely. Yeah, Jose, see, now, here's the other thing too. Don't forget, let's say you just keep your house for 10 years and then you want to sell it, correct?
right,
Well, in 10 years, again, part of the money you put in has accumulated. So if you say, well, I'm just going to have my house for 15 years and then I'm going to resell it or I'm going to flip it or whatever else you want to do with it. Well, don't forget, part of the money you put in is still there. So this is not homeowners insurance, which is a total different thing. With homeowners insurance, you pay because it's the law, right? But
right,
you
right,
pay it. But let's say in 10 years you sell your house, you don't recuperate any of that money.
right. No, that's
Okay?
true.
You don't. It's just there. But with this, okay, that is designed to protect your mortgage, okay, then there's greater value in it. Now the good news is it's optional. It's not a law, so that's why probably you have not heard it. People have not heard it because it's something that it's optional. You have the choice to say yes, and you have the choice to say no. With a homeowner's insurance, you can't say no. They
Right.
need you to have one. So
Let me ask you this question, though. I mean, I know time is running by so quickly, and I really wanted to spend a little bit more time, but I just trying to make sense and try to grasp as much information as possible from you. I know you got a lot more to say, but I needed to really know. Let's say someone already bought. Can someone that bought a property, can they buy this program, or is it? I mean, can anybody that owns a property, can they buy this product?
sure, definitely. This is not just for the new homeowner. This is for someone that has a property. This is for someone that has an asset. This is for someone that needs to protect their values.
Okay.
Okay, their value possessions. So if you bought a house 5 years ago, oh sure, you can get on this, absolutely. If you're someone that bought a house 10 years ago, of course, because you still have a mortgage to pay. So you still have something to protect. If you bought a house yesterday, absolutely. So it really doesn't matter. You could be, listen, you could have bought your house 15 years ago, but if you still have a mortgage to pay, you can still access this. Anyone can. There's no restrictions.
Wow. Okay. So basically, I mean, so anybody can. So if there's mortgage, you can access this program. What if someone doesn't have mortgage?
Sure. Well, see now you're touching into a most wonderful thing. If someone doesn't have a mortgage, they can still utilize the product, if you will, or the features of it, but it will not be to pay their mortgage. This will be now. See, this can be utilized for someone that just simply wants to protect their value of the home. If a home is worth 200,000, 300,000, and the person
Yeah.
says, I want to take something to protect, accumulate cash. Some people do it they see it as an investment in their own little way, because they figure, well, if I put $1 in 20 years, I'll have, $4 just because. At the end of the day, Jose, let me put it to you this way. Cash is cash. And that's what happens with this product. The money you take out, it's your money. It was originally intended for you to pay your house off, but if you want to use it for other means, that's up to you. That's why I said before, when we first started our conversation, that this is strictly designed for the homeowner. It's not for the bank, it's not for the mortgage company, it's not for the lender, it's for the homeowner. The homeowner chooses what they're going to do with their money.
All right. Just to pretty much wrap this up, I see the value. To be honest with you, I'm really excited about this program that you're bringing over, and I also understand what is the benefit of it. Now, how do you shop around for something like that? I mean, of course, I'm going to provide your information, but I mean, let's say if someone wanted to shop around and find out uh, and not get tricked into something that is not like this. I mean, there are a lot of companies out there, or I mean, I'm sure
Sure.
that you said that this program has been out there for a long time.
Sure.
That someone like me, for example, that I don't know, I just came into knowledge for this program, and I mean, is there a difference in monthly payments? Is this a law set for a specific thing? Or, I mean, how can someone say, okay, you know what? I don't want to get robbed. I want to have a fair market payment that I am not being robbed by making an extra payment that is going to benefit somebody else. In reality, I don't see it as being robbed, because at the end, if you're making 40%, reality is, I mean,
Yeah.
that's a lot of money. But tell me a little bit about that, because I don't know it, and I'm sure that there's questions out there that there are probably people that are going to ask themselves the same questions. I mean, I know the industry is up for. I mean, people can do anything, and there, as you know it, in the industry, there's a lot of people that will say things that are not ethical and try to go around the system and try to trick other folks that are not knowledgeable about this program. So tell me a little bit about that.
Sure, sure. Yeah, I mean, if you're out there and you want to shop around for this, I'm sure there's multiple companies that could that offer this. Like I said, this is not a new product. It's been around for centuries, really. My only advice would be when you're shopping around for this particular kind of protection or insurance, I would strongly encourage you and your viewers to go with a broker. And the reason why I said a broker is because a broker has access to multiple companies and multiple carriers. The broker's the broker's duty is to find you the best possible product at the best possible rate for you. If you find someone that strictly works for one company, most likely that person can only sell you that particular company. Make sense? So if you want to shop around, it's like I'm guessing it's like the banks. If you need someone to get a loan to someone to buy a home, you don't. If you were to work for one bank, well, that's just the bank it is. But if you have access to multiple banks, you might try to be able to find the best rate, if that makes sense.
Right.
I'm not really sure how it works on your end, but with us, it's the same thing. So, going with a broker is definitely, you have a better opportunity to kind of shop around. And before you signed anything, before you even commit to anything, these illustrations that I showed you are to be shown to you. So you now have a visual value of what you're getting into before you sign anything.
Right. Well, that's good explanation. Then I appreciate that, Jeff. And I appreciate your honesty and sharing that with us. Unfortunately, the time has actually come and brought us to an end. So, but I want to thank you for sharing this information. And I know it's not going to be the first time that we're going to do this, but I want to let everybody know that if you need to get in contact with my friend Jeff and you want to ask him a few questions and that you're not sure about this, I'm going to post his website right on the bottom of this video, and also his information where he could be contacted, and that way you can ask him any questions. What better person to answer your questions than someone that is in the industry. But this really made a lot of sense to me, and I felt that I really wanted to share this information with every homeowner that is out there. So again, Jeff, I want to thank you for your time. I want to thank you
for having me. Thank you for inviting me and the opportunity to share this valuable information to all your clients and your viewers.
Thank you, Jeff. All right. Thank you, everyone. Have a good day.
Thank you.